Hey, I'm JD Frost and welcome to the Accountability Show. Thank you so much for tuning in. Please make sure you turn on your notifications so you know when a new episode drops. We are talking about the 4 foundations of wealth creation. One of my favorite things to talk about. I actually am writing an ebook about the 4 foundations of wealth creation, and I hope that you're able to check out that in the link below. Can we do that? Yeah, click on that link and you'll be able to get that ebook. But in this episode, we are talking about our second foundation of wealth creation. And if you watch the prior episodes, I hope that you watch those and that you start to understand that really wealth is determined by you. You create what wealthy is to you. It is what is important to you. It's important to define that on the very front end. But if you are like me, then you believe that wealthy comes from individuals that are making at least over $100,000 a year in order to start to create wealth, to accumulate wealth. If you do not determine it that way, that's perfectly fine. But this section, this particular foundation, might not have that much interest to you because we're talking about tax savings. As your income continues to increase, what most people don't understand or realize that I've seen is that your taxes are your largest expense every single year. I don't know if you ever thought about that before. Your payroll taxes, your Social Security taxes, your property taxes, your local and state taxes, and your federal income taxes. That's almost every individual on this planet, well, not planet, I guess in the United States of America, is going to be paying those taxes every single year, no matter what your income level is. So a foundation, the second foundation of wealth creation is tax planning. Those individuals that are creating a significant amount of wealth need tax planning all throughout the year. Some of the most wealthy individuals that we help on taxes, we meet with them every single month in order to tax plan. And there's 3 reasons why you do tax planning. The first reason why we do tax planning is in order to calculate what's called the safe harbor calculation. The safe harbor calculation allows you to eliminate unnecessary penalties and interest. The IRS actually requires you to pay in 110% of your prior year tax or 90% of your current year tax in order to avoid these penalties and interest. Now, these penalties and interest aren't a significant number, but if you're paying a large amount of tax every year, it can get fairly significant. It can get to $2,000, $3,000, $4,000, $5,000 of penalties and interest if you don't calculate this. That's one reason why we do tax planning. The second reason why we do tax planning is to predict what your tax is going to be, what your tax liability truly is, so that you don't have any surprises, so that if you have additional investments that you're making, that you don't have to liquidate those investments in order to pay your taxes, so that you can plan for that expense that's coming up. And speaking of expense, it's not truly an expense. This is an actual cash distribution. It's cash outflow. It's cash out the door. It's not really a deduction at all. I just like to say expense because that gets people's attention. People understand expenses. That means money going out. So tax planning allows you to calculate the safe harbor calculation, and it also allows you to predict what your tax liability is going to be. The third reason why we do tax planning and why this is such an incredibly important part of wealth creation, the second foundation that is because we want to eliminate or reduce that tax liability as much as possible. And we eliminate or reduce that tax liability as much as possible depending on quite a few factors. The way that we help our clients with their tax planning and reducing that tax liability is through 3 different systems. We have a tax planning system. We call it our tax planning blueprint system. We also have what's called the JUMP method system, and then we also have the Croft tax system. And in the Croft tax system, we utilize our 5 pillars of mastering tax strategy. And if you haven't checked out that ebook, please click the link below as well so that you can see that ebook and read about our 5 pillars. There are a number of different strategies. There's so many different ways to save money on taxes inside the tax code, but these 5 pillars are the ones that we seem to use the most among all of our different clients. So tax planning, being that second foundation of wealth creation, involves a number of different methods and systems that we offer to our clients. And I just want to inform you a little bit about each one of those. So our JUMP method system allows us to justify actual business expenses, utilize the tax code effectively, maximize deductions, and protect you from the IRS. We are able to utilize entity structuring and what we call our expense call in order to identify additional deductions that you can take in your tax return. What's really interesting about most taxpayers and CPAs in that relationship is the more that you communicate with each other, the more opportunity you're going to find. You're going to figure out where you can take deductions and where you can't. You're going to identify certain strategies that you can use in one year and strategies that you're not able to use in another year. And so it's very, very important, and a critical part of the JUMP method is literally this expense call. So it's the simplest part, but it's the most critical. Our Croft tax system allows us to utilize the 5 pillars of mastering tax strategy in order to save money on taxes moving forward, reduction in taxes. And so this is a strategy that we use, and those 5 pillars are entity structuring, Lord, this is going to be a test, tax planning, tax method of accounting, specialty industry tax credits and deductions, and captive insurance companies. See, I know the 5 pillars. But those 5 pillars include a number of other strategies underneath them that we use across all different taxpayers. So with the Croft tax system, we utilize the 5 pillars. With the JUMP method, we utilize that expense call and entity structuring in order to save money on taxes. And then our tax planning blueprint, which I'm very excited about this year, we actually utilize AI technology in this software that links up the tax code with your income tax situation, and it allows you to be able to take advantage of every single tax deduction, every single tax strategy that's in the tax code. I've never seen anything like it. And it's a software, so it's more powerful than my brain, I know. There's no way that I have the whole tax code up in my head and how it can apply to your situation. But this blueprint is going to create a way for you to implement tax strategies and savings into your 2021 tax year. So very, very important. This second foundation of wealth creation, tax planning, this foundation is extremely important as your income continues to grow, because you want to keep more of it so then you can utilize it to execute our third and fourth foundation of wealth creation. Thank you so much for tuning in to the Accountability Show. I appreciate you so much sharing this and liking it and subscribing to the channel. Please tune into the Daily Ledger podcast as well, and give me a follow on Instagram at jdfrost.today. Hope you have a great day.